Welcome back, everyone. In this episode, we're going to be going over an inside look at what super investors have been buying. It's that time of year again where anyone that controls over $100 million in assets under management is legally required to disclose what they've purchased. So we get an inside look at what these super investors are buying. And these are many big names. People like Warren Buffett, Christopher Bloomstran, Michael Burry, Daniel Loeb, Josh Tarasoff, Seth Klarman, so on and so forth. We have a whole list we're going to go through. I'm going to be looking at the top companies that they've bought over the past 3 months, and we're going to be doing a little mini analysis on each one of them. So I think this will be an interesting one to go over. We get a look at what the pros, the professionals with billions of dollars, have been buying. So we have a lot to jump into in this episode, a lot of ground to cover. Let's go ahead and jump right in. A quick mention, the tool that we're going to be using here to do analysis on these companies is Qualtrim. It's called Qualtrim Insights is the name of this specific feature. I built this tool, the whole thing, with people that I previously worked with at my development job. And you're able to try this out risk-free. It has a free trial by using the Patreon link in the description below. Another thing we're going to be using here, this website's called Dataroma, and it gives you the 13F filings the day that they're released. So we can look at what's recently happened with all of these people. The first one that I obviously want to go over is Warren Buffett. And I'm going to skip the introduction this time, because everybody knows about him. Now let's go ahead and jump in and see what Warren Buffett has been up to. Now the biggest companies that Buffett has been buying are two different companies, Occidental Petroleum and Paramount. And they are very different companies. It's a little bit confusing to see this from Buffett, but I'll go to the one that I think for sure is a Buffett buy. Occidental Petroleum increased the position by 22%. He's been buying this company hand over fist. Buffett's really big into energy. Berkshire has a massive energy business. It's like one of the big pillars of Berkshire Hathaway. They have insurance, they have energy, they have a lot of Apple, they have some other companies, but energy is just a massive industry within Berkshire. Let's go to Occidental Petroleum, not Realty Income Corp. All right, we have the right company pulled up here. Occidental Petroleum. The company has done so well. People, they used to make fun of Warren Buffett like a year ago when all the tech stocks were going up. But then we look at Occidental Petroleum, a company that Warren Buffett's been buying like crazy. It's up 136% in the trailing year to date, just this year. What a phenomenal buy by him. He really outplayed a lot of investors here. We look at the company, it looks exactly like a Buffett buy. It's a high free cash flow company. We look at it year over year here. It's had explosive free cash flow growth. Even this year, if we zoom into this quarter, it's posting $3 billion, $4 billion, $2.3 billion in free cash flow, just massive. And all the people saying that we're moving away from oil companies, it's going to happen sometime down the road, but it will probably be another 30 years. So this type of company, I think, will produce a lot of free cash flow. That's the type of thing Warren Buffett wants. Companies that can just pay him out mass amounts of free cash flow, and he can reinvest it elsewhere. The other company that he invested heavily in that's a little bit more perplexing to me is Paramount. And I'm not sure if this is a Buffett buy. This might be a Ted or Todd buy or someone else at the company, one of his lieutenants. But Paramount Global's number 2, a 16% increase, 12 million shares. This one, it's a cheap company. It trades at a low PE ratio, but I have not been a fan of this buy from Berkshire since the beginning. They've been buying this company for quarter after quarter, the entire year they've been in it. And the whole time I've thought that this company is a value trap. I simply think there's too many risks with it. I don't think it has the scale of Netflix. I'm invested in Netflix. I'm invested in Disney. I think that Disney will easily have scale. I think Netflix will have scale. They already do. I think Par is going to struggle. Paramount Plus is a streaming service, doesn't have a lot of amazing content on it, and I really think it's going to struggle. The last quarterly financial reports weren't great. The free cash flow is moving to the negative. The growth in streaming is okay, but they're shedding a legacy cable business and all this licensing. They're somewhat in the same situation as Disney, but I don't even think is good. So this one is a little bit more perplexing to me. It's just not, it doesn't strike me as a Buffett buy. This one doesn't. Another thing that's concerning about this company, they have a ton of debt. $15 billion in debt. Their cash balance is going down. They're trying to repay their debt. They have a dividend that they're paying, but they probably should scrap the dividend until they get the debt a little bit under control. Right now, Netflix doesn't pay a dividend, but they're doing share buybacks and paying down debt. So I think that'd be a better route. Right now, the dividend's completely flat. So I've seen some value investors follow Buffett into this buy, and I think it's fine. It might do well. Maybe we'll see it recover, but in my opinion, I just think there's better companies in the media sector. I'd rather own Netflix or Disney or even Amazon with Amazon Prime. There's lots of different companies I'd choose over Paramount. Now, the next super investor we're going to be looking at is Pat Dorsey. He has $785 million under management, so he's managing a substantial amount of money, and he has an interesting history. Pat worked at Morningstar from 2000 to 2011. Morningstar is that big research firm, and he was instrumental in developing the Morningstar Economic Moat Rating. So that's a big part of Morningstar is the moat rating. They have the moat of wide or narrow. They have the moat that's widening or narrowing over time. That's a big part of their research analysis, is looking at the moat of the company, which is a competitive advantage. So this is the Morningstar moat guy, and let's go ahead and look at his trades. If we look at what he bought or sold last quarter, there's actually not much of a change at all. He basically held his portfolio perfectly steady. He bought a tiny bit more of each company, which I think is probably new additional asset flows. He just deployed them evenly across his holdings. Now, if we look at what's happened with Pat Dorsey's portfolio, it's actually been a bit tragic over the past couple of months. I mean, he has really taken a hit. This has been pretty unfortunate. Wix was his top holding. Let's go ahead and take a look at Wix here. This is a company that I once did analysis on, and ironically, even though Pat Dorsey's the moat guy, I didn't buy this company specifically because I didn't see a moat. I thought it was basically a commodity. It's an online e-commerce builder that has shopping cart tools and different things you can do, similar to Squarespace, similar to Shopify, similar to many other companies. Again, I didn't think that Wix had too much of a moat. Otherwise, it's a pretty great company. But this one's down 46% year to date. He's taken a pretty big hit on it. We look at his second biggest holding, Smartsheet. This one's ticker symbol SMAR. This one's down 59%. His third largest holding is Meta. Meta, of course, is down big this year, down 66% year to date. His fourth largest holding, Roku, and it's just disastrous. Roku's down 75% year to date. And I can go through almost every one of his holdings, almost all of them, and they're all down big. His fund has taken a massive hit. So I'm not sure what's going through his head. I think this has to be a very difficult year. Maybe he'll be able to recover, but right now I've seen Pat Dorsey's portfolio, being the Morningstar research guy, being the moat rating guy, he has had one of the worst performances this year out of anyone that I've looked at. Now, next up, we have a super investor that I really like to follow. His name is Josh Tarasoff of Greenlee Lane Capital. Josh Tarasoff currently controls $270 million, and I really like this guy. There's some things that I like about him, like the fact that he started his fund from his bedroom. He literally had a desk in his bedroom, and that's where he ran this big hedge fund from. All of the research he did relied on his own analysis. No employees, no analysts, just him and his thoughts. His research on Amazon back in 2012 was phenomenal, and he did additional research on it before that. His entire investment case for Amazon proved to be incredibly accurate, and that's how his fund has grown to hundreds of millions of dollars. Most of it is from gains. So he's someone that I'm excited to look at and see what he's been up to. Now, if we look at his portfolio and what's happened over the past 3 months, let's take a look at his top buys here. He's been buying a lot. He's been deploying capital, which makes sense with the trade down in the market. First of all, we have Spotify. He increased the position size by 50%. This has been a holding that I've been bullish on before. I've seen the investment thesis. I actually think that Spotify does have an incredible product, global reach, potential to become highly profitable. I sold out of the company out of frustration that quarter after quarter, their margins never improve. They seem to be just dragging their feet along in profitability. So Spotify is one of the companies that still remains on my watch list. And as soon as I see Daniel Ek start to pull the levers of profitability, start to increase margin even a bit, if I see that trend at all, I'm going to be jumping back into Spotify. But right now I'm just sitting on the sidelines waiting for them to prove profitability before jumping in. Now the next one that he bought into is one called Monday.com. Those of you that work in development may have used this company. I actually used it at my previous job. If we look at Monday.com, I think it's MNDY as a ticker symbol. This is basically a really fancy to-do list for companies. It's really nice. It's like a development kind of Jira software where you can have a task list, you can assign it to different people, you can put it in different statuses, you can take different notes, you can organize it in different ways. It's just a fancy to-do list. And to-do lists are important for people that do things like programming. So this is a company that I've actually used their product for some portion of time, and I think it's great. I think it's a really good product. It suffers from the same thing that I think Wix suffers from. I don't see it having much uniqueness. I don't see much of a moat here. There's lots of products like Jera and so many others that do something very similar to Monday.com. So I think the switching cost is not substantial. A company can switch off of Monday.com onto Jera or vice versa pretty easily. And that's the reason that I have avoided this investment. I've actually looked at it before, but I haven't invested in this one. The company right now is not free cash flow positive. It's one of these ones losing cash, paying employees a lot, pre-profitability, if you will. The stock has been crushed year to date. But again, Josh Tarasoff has been adding to the position now. So he might think that now's finally a time where it's gotten to a decent valuation. But either way, Monday.com is not a company I plan on buying. Now, the next one that he's been adding to is Google. And obviously, I think this is a good move. I think he'll end up making money on this buy. Google's down 30% year to date. And I don't think it's going to be the lows for Google. I think this company will return back to its all-time highs. Then we have another company he added 23% to, ticker symbol BUR. This is one that we don't have a lot of information on. Burford Capital Limited, through its subsidiary, provides legal and financial products and services. I don't plan on buying any companies like these asset managers. I think they're risky. I think they're difficult for me to wrap my head around. And then the next one he's been buying is Trupanion. Trupanion is down big this year, so it makes sense he'd be buying into it if it's been on his watch list. And it's actually bumping up a little bit today, up 13%. It has very consistent, strong revenue growth, but the profitability metrics, they look like there's a lot to be desired. We don't have consistent free cash flows. We don't have profitable EBITDA, net income, earnings per share. We do have a strong balance sheet. I think this is probably a stronger play than most of his companies. I imagine any company that's going into pet insurance is going to be doing well because there's so much demand for that right now. But that's basically it. After that, he's just been adding to more positions like Shopify, Salesforce, and Amazon. And it's notable that he added more to Amazon even though it makes up 23% of his portfolio. It's still an oversized position, and he's held this position for over 10 years. Now, next up, we have a massive super investor, Daniel Loeb at Third Point Capital. We just talked about Josh Tarasoff, who controls a couple $100 million in assets. Daniel Loeb controls over $15 billion. Third Point is a massive hedge fund, and they call it an event-driven value investing hedge fund. Now, Daniel Loeb did a massive buy last quarter. He bought a lot of one company in particular, so much of it that it moved it to his top holding. The company is Colgate, the toothpaste company. Now, you might look at this and think it's very boring, and that's accurate. This is a boring company. I think boring companies are great. Colgate is a consumer staple. They make toothpaste and some pet products and oral hygiene products. The company's only down 12% year to date, so it's holding in okay. And like most consumer staples, this company is a compounder. It continually grows revenue at a very slow, steady rate over time. It has consistent earnings over time, has consistent free cash flows, doesn't spend too much on stock-based compensation or other expenses. And this is what you look for in a compounder, a company that pays dividends, does share buybacks, grows free cash flows, has pricing power, has brand value. That is Colgate. This is the type of company I really like to have in my portfolio. If I had to ask him, I think the reason that he bought so much of this company was simply to batten down the hatches, so to speak, to simply play a little bit of defense this year. I think that's why he put so much money into it. He also bought T-Mobile. I don't know about this one. Telecom company, I think it's okay. I think it's also a conservative play. Another company that he bought a lot of, that he's been bullish on for a while, is Disney. He really likes all the intellectual property and all of the streaming services, and he thinks that Disney's executing relatively well. Now, another quick observation is a couple new holdings that Daniel Loeb bought last quarter. This company's cheap, but it's not one that I would go into. Cheap retailer that I don't think has a huge moat. Maybe I'm missing something here. But I don't really love this buy into Bath & Body Works. I don't know what the thesis here is. Maybe somebody can fill me in. I'm not sure about that one. He seems to be buying a couple retailers like this. He also bought a stake in Twitter. He probably looked at the Twitter legal case with Elon and thought that there was no way out for Elon. So he bought Twitter with the arbitrage play, and that paid off. Now, I will mention with Daniel Loeb, this guy likes to move in and out of companies relatively fast. So he goes into companies quickly, he moves out of companies quickly. I would not try to copy his portfolio because if you copy it buying into one company, he might be out of it in a week and you'll have no clue. Now, after Daniel Loeb, we have Michael Burry. Needs no introduction. He controls around $3 billion of assets under management. The biggest company that he bought last quarter was Geo. Geo is a company that I don't know too much about. I have no interest in really doing research in it because it's a private prison. It's just an industry and a a type of investment that I really have no interest in. Now, there's lots of people that will argue over the ethics of private prisons. Michael Burry is one of them. He posted on Twitter his argument for why he doesn't think they're unethical. He thinks they serve a valuable purpose. Viewers may disagree. I'm not arguing otherwise, but he doesn't see this as an unethical thing to invest in. But Geo Group is by far the biggest thing that he bought over the past quarter. I have to give a similar caveat with Michael Burry. This is someone that I would really warn not to try to follow his trades. You are not going to be able to mimic Michael Burry's returns. He goes long, he goes short, he uses options, he trades in and out of companies all the time. Some companies he holds for a long time, some companies he holds for a week. So you never know what he's doing. These reports that come out every 3 months, they're more geared towards mimicking long-term investors that have buy and hold strategies like Buffett, not people like Michael Burry. Now, next up, we have Christopher Bloomstran. He's a value investor that manages around $300 million. He's also a big fan of Warren Buffett. Berkshire Hathaway is his top holding, making up over 20% of his portfolio. And he's someone that I think is really good to go to if you want to learn about Berkshire Hathaway, their insurance businesses, their energy businesses, and get a full understanding of it. Look up some podcasts from Christopher Bloomstran. Now, like I said, he is a big fan of Warren Buffett. And that's reflected in his holdings and some of the companies he's bought. He's bought into Paramount Global, just like Berkshire Hathaway. But this is a company, again, I'm unsure of. I think it's more of a value trap. He also bought even more Berkshire Hathaway. So even though it made up over 20% of his portfolio, he increased his position size by 10%. He bought Olin Corp, OLN is the ticker symbol, which is a chemical manufacturer. And he bought Mercury General Corp, which is one that I was unfamiliar with, but this is an insurance company. So he likes the insurance businesses, he likes the commodity businesses, and he's investing more in Berkshire Hathaway, which I agree with this purchase. I recently bought more Berkshire Hathaway. This is a company that I do think will outperform the S&P 500 over the next decade. So I agree with most of his purchases. And if you look down the list, most of them are just simple value investing businesses. Productive, free cash flow generative businesses. So I like his portfolio. I think he has a very strong, durable portfolio that's never going to explode. It'll never have something like a Cathie Wood, Tiger Global event happen to this type of portfolio. Now, next up, we have Seth Klarman of Budapest Group. He's an incredibly successful value investor that manages over $5 billion. He also wrote the book Margin of Safety, which is one of the value investing favorites. Now, if we look at his activity over the past 3 months, his biggest buy by a little bit is Warner Bros. Discovery. Let's go ahead and look at this one, ticker symbol WBD. Now, Warner Bros. Discovery is another company that I haven't been very bullish on. Again, my picks in the streaming industry have been Netflix, Disney, Amazon, Apple. Those are basically it. The companies outside of that, I think, are having troubles with their legacy businesses, getting to scale. I think it's very difficult. And my biggest gripe with Warner Bros. Discovery, the reason I haven't bought this company, is the substantial debt that they're dealing with. This chart right here shows $48 billion in long-term debt. Now, they are paying it down, so you can see the decrease quarter over quarter. But even with massive payments towards their long-term debt, they have years and years and years, 5 years, 6 years plus, to be able to get this down to a reasonable level. When AT&T offloaded Warner Brothers Discovery, they used it as an opportunity to offload a ton of debt. So I look at this as a very debt-heavy company. It does have significant free cash flows, that's the positive. But for me, this just makes it difficult. If this company had a lot less debt, I might consider it more strongly. But right now, between the legacy businesses, between the streaming struggle and competition, and between the huge amounts of debt, I personally think that Netflix is in a better position. So that's the one that I've been in. But look, Seth Klarman is the pro. He's the one managing lots of money. He's buying Warner Brothers Discovery. We also have GTN, Gray Television. I have no clue what this company is. I can read about it here. Gray Television is a broadcasting company that owns and operates television stations, digital assets in the US. It broadcasts secondary digital channels, ABC, CBS, NBC. So this is a broadcasting company, one that I don't know anything about. From the fundamentals, it looks okay, but this one again has been struggling a lot, and it also has quite a bit of debt, it looks like. This company says that it operates as an advisory, broking, and solutions company worldwide. It operates through 2 segments, health, wealth, and career, and risk and broking. Seems all very vague. I'd have to study this company a lot to really understand their business model, but that's one that I don't know anything about. Another company that's popular amongst super investors is Micron Technology. This is one that Monish Pabrai has been in. Now, overall, looking at his entire portfolio, even with these most recent buys, This is a portfolio I really don't understand. I don't recognize half the companies in this portfolio, so I can't comment on a strategy that much. You might be looking at different factors than I am, but many of these companies, in fact, around half of them, are simply ones I don't even recognize. Now, finally, the last one that I'll mention here is Terry Smith. In my opinion, I think he's one of the best super investors with the most well thought out methodology and look at investing. I think there's a lot that the average investor can learn from him because he's a long-term buy and hold value-oriented investor. He has 3 simple steps: buy good companies, don't overpay, and do nothing. And over the past decade, he's outperformed the S&P 500 by a decent margin. And he's also authored the book Investing for Growth. I'd recommend reading that. I've read it. I think it's fantastic. Now, let's go ahead and see what Terry Smith has been up to. He's made some trades. They're pretty spread out, so he's buying a lot of his companies. But his biggest buy has been Mettler Toledo. This is a company that I've been unfamiliar with until I recently went into it and looked at it because Terry Smith bought it. And wouldn't you know, this company has tremendously good fundamentals. And we're talking about incredibly good fundamentals here. Does it have revenue growth? Yes, it has revenue growth. 5% per year for the past decade, consistent revenue growth, consistent EBITDA growth, consistent free cash flow growth. Even when you factor in stock-based comp, the free cash flow is real cash flows going back to the shareholder without substantial dilution. We have net income growth. We have earnings per share. We do have some debt on the balance sheet here, but when we compare that debt to the amount of EBITDA they generate, they could pay that debt off in less than 2 years. So they're not growing by leveraging their company to a huge extent. And the company's doing share buybacks. They removed 2.83% of the shares outstanding over the past year. And like every company that Terry Smith buys, one thing that I look for, that I see with almost all of them, there's only a couple exceptions, it has high returns on capital employed. And this is something that in this case, the returns on capital employed are actually increasing over time. Strong trend going up, not just being level or going down. So this company's fundamentals right now on paper are spectacular. Then you look at the industry this company works in, and the company basically provides laboratory instruments. It has a whole array of laboratory instruments that are vital for any type of medical purpose, veterinarian, any type of application that you might need lab instruments. So the company has a product that's not going to go out of style anytime soon. I gauge the fundamentals of Mettler Toledo as incredibly strong. And even though the price is a little bit more lofty, I think those fundamentals warranted. Another company that he entered into as a new position is Otis. Now this company is a spinoff. It's an elevator company, which sounds really boring. And it is. But Terry Smith likes these type of companies. These boring companies have very predictable profits. In this case, the reason that Otis is such a predictable company is elevators are something that's never going to go out of style. They're not trendy. They're always going to be needed. And even after you're done selling one, they require continual service. So Otis makes a ton of money through continual service of their elevators. They have contracts that they make lots of money doing that. And I think this one's a very good pick from Terry Smith, another company that I've looked at adding to my portfolio potentially. The revenue is very consistent. It'll likely grow at a slow pace over time. The profitability will grow slightly faster. You see the EBITDA here. The free cash flow, also very consistent. Free cash flow productive company. Has good net earnings, good EPS, isn't over-levered, pays a growing dividend, does share buybacks, has high returns on capital. It checks all the boxes for a Terry Smith investment. So Otis is another company that's not surprising it ended up in his portfolio. He bought it up to a 2% position, which is pretty significant for him. That's a pretty decent position. The last one that I think is worth mentioning is finally Terry is on board the Apple train. He's finally on board of it. I predicted this one a while back because I view Apple not as a fashion company. I don't view it as a fashion brand company. I don't view Apple as a tech company. I view Apple more as a consumer staple that has really good economics. Similar to Otis, they sell a device and then they have services on top of that. And I think that Apple has a lot of levers yet to pull to grow profitability over time. And I think the company has a very wide moat. They also have high returns on capital employed, which is something Terry Smith looks for. So overall, I'm not shocked by any of these purchases. Some people were surprised, even shocked that he bought Apple because he once spoke negatively about it, explaining why he wasn't going to buy it. But good investors like Terry Smith, they change their minds. Sometimes they sell companies that they no longer want to own. Sometimes they buy companies that their original thesis on not owning them was wrong. And that's what I see from Terry Smith. He's able to adapt and take in new information. So there you have it. There's what the super investors are doing with their portfolios. Now, I'll have more updates like this in the future, as well as what I'm doing with my portfolio. I'll give you another update. We have a lot more good content coming out soon, so make sure you're subscribed, and I'll see you in the next one.